you were starting to go into the Secure Act 2.0. As we all know, the rules and regulations surrounding retirement savings are constantly changing. You would reference this law was passed at the end of 2022, late December, I believe the 29th of 2022. So can you start by just kind of going into some of those changes and what they involved and whether or not they're going to benefit, or in your opinion, benefit or hurt the dental practice owner?
Perfect. So yes, just to reiterate, President Biden signed this into law on December 29th, 2022. And that's a very important date because that's the effective date once he signed it into law. And I'm going to be referring back to that date throughout a lot of the slides that I'm looking at right now and a lot of the conversation we're going to be having.
Okay.
So part of the Secure 2.0 Act, they expanded the Roth opportunities. In previous podcasts, I talked about how Roth contributions are allowed within a IRA account, individual retirement arrangement, and also through 401k plans. They've now expanded this so Roth opportunities are available in other type of retirement accounts.
Okay.
That is definitely a big deal. So although these rules take effect January 1st, 2023, these rules actually already started the beginning of the year we're speaking in right now. None of the plan providers, the mutual fund companies out there, the broker dealers, they were not able to comply with this law yet because they have to change everything they have to do. So I haven't had one client that was able to take advantage of this yet. But technically the law became effective January 1st. And speaking to a lot of the plan providers, like for example, American Funds, Fidelity, a lot of them said that starting January 1st, 2024, these will now be available. So it's going to be a case by case. So a lot of what I'm talking about, no one's ever implemented yet, but I want each of the listeners, if they fall into this position, be one of the first to take advantage of all of this new news.
Awesome. Thank you.
So we'll, of course, stay tuned to see how all that develops, but that's basically the story.
Okay.
So first thing we're going to talk about is the law now changed and allows simple IRA accounts to also do Roth contributions. That was never allowed before.
Okay.
In addition to that, an employer contribution was always in pre-tax dollars. They now are going to allow even employer contributions to be Roth contributions.
Oh, wow. Okay.
That's never been done before. Now, the tricky thing there is the employee has to elect into that. Okay. Otherwise, it won't be a Roth contribution. But here's the tricky part to that is, let's say the employer puts $5,000 into a Roth for you. That full $5,000 is going to go into the Roth. You still owe taxes on that $5,000. So that's where it gets a little tricky for people.
Yep.
In a financial position to take advantage of it, this is going to give you a lot more opportunities now to sock away a lot more money into Roth accounts. And a lot of clients that I work with, it's about 50-50. Half of them love traditional. They want the upfront deduction. The other half say, I'm making plenty of money now. I could afford to do the Roth. I'm doing it. I'm looking forward to a tax-free retirement. Plus, if you're a believer, as I am, that tax rates are going to go up significantly in the future. That's a really good argument to do a Roth IRA. And as we've talked about in the past, the government has been out of control, probably over the last 10 years at least, in spending so much money, raising the debt, the national debt. So eventually, I don't see how taxes aren't going up. So that's an argument to contribute more money to a Roth. So as I mentioned, although these rules were effective January 1st of 2023, most people will have an opportunity to take advantage of this starting just in a couple of months. But you want to speak to your pension plan provider, your investment advisor, your accountant, make sure they're aware of these rules so that you can put yourself in a position to take advantage of this. So the other thing is the catch-up contribution. As I mentioned, you could do a catch-up contribution through your 401k plan. Effective January 1st, that contribution is mandated to be treated as a Roth contribution. So again, assuming you were contributing $22,500 in 2023, and then you're going to contribute $7,500 as a Roth 401k deferral, that you're going to have to put in as a Roth contribution. You can't do it as a pre-tax contribution.
Okay.
So that's mandated. They did carve out an exception. So if the taxpayer, if the dentist is earning less than $145,000, the government's not going to impose that rule on them. They're going to basically say you don't have to meet that mandate. They're going after high income earner dentists that are generating $145,000 or more. And why are they doing that? Well, they're saying, well, we want to capture some tax dollars, so we're going to do that, but we're going to force you to put money into a Roth IRA. Personally, I think it's a mistake that they did it because what they're doing again is collecting tax revenues now that they're not going to collect down the road, the government. Basically, I can't say everything the government does makes no sense to me, but unfortunately, most of it doesn't make sense. But this is a good opportunity because if you're a high income earner dentist, they're now going to force you to do more Roth contributions. So for that, I'm going to say thank you to the government. But from a fiscal responsible point of view, I don't completely agree with the decision they made there. But who am I to say that, right? Just a taxpayer.
Right.
So now, in addition to that, the Roth contribution has been expanded, as I said, not only with 401ks, 403bs, even 457 plans if you're a government employee. So the new act now allows these defined contribution plans to provide participants the option to do the match on a Roth basis as well.